welcome to all our viewers. Welcome back to our regular NFO series where we speak to the top management, fund managers, top hierarchy of the AMCs to understand the new fund that is coming into the market. We understand what are its features, its benefits, and insights about the fund to understand why it is worth investing. And today we will be discussing the ICICI Pru Nifty 500 Index Fund. The NFO period has begun from December 10th, 2024 and will continue until December 17th, 2024. And to speak about the fund today, we have with us Mr. Amit Vashisht, Head of Digital Sales at ICICI Pru AMC, and industry veteran with over 16 years of experience in the finance and sales industry. And welcome to the discussion, sir. So happy to have you here.
Thank you, Vinay.
Yes. Sir, let's dive right into the questions first. It's about the index composition and the strategy of the fund. So how does this Nifty 500 index fund ensure representation across different market capitalization? That is across large cap, mid cap, small cap, while maintaining the balance and diversification.
Great. Before we talk about Nifty 500, we just try to explain what Nifty 500 means. So it's basically the index created by NSE. The top 500 companies in terms of free float market cap will be part of this portfolio. So when we use free float, it indicates the companies, those stocks which are available to trade easily. We remove the stocks of the majority stakeholders. So the promoter generally doesn't come and sell their stocks easily on the market. So we remove those kind of stocks. We keep only those stocks which are in the secondary market and available to trade. So that gives some more liquidity. That will follow free float market cap, not on the market cap. So this index covers the top 500 companies in basis of free float market cap. Now consider the entire listed entity in India. 94% of the entire listed entity comes in top 500 companies. So if we are looking into Nifty 500, we are actually looking for the entire India because we're covering the entire 94% of the India markets. So that's the beauty about this top 500, Nifty 500. Now the most popular index which you heard about is Nifty 50, Nifty small caps, Nifty mid cap, Nifty next 50 or Nifty 100. So all these are dedicated to particular sector. When you talk about Nifty 50, you're covering the entire large cap space. When you talk about next 50, again, it's a large cap space because top 100 companies are majority large cap. When you talk about Nifty mid cap, which is covering only mid cap. So we have seen in active mutual funds, there are a lot of flexi cap schemes, multi cap schemes. So if someone wants to participate in a flexi cap kind of a strategy in the passive, this index is truly representing the passive style of flexi cap. 70% of the portfolio, current portfolio is into large cap, 20 into mid cap, and 10 into small cap. So ideally, anyone should create a portfolio. He should keep at least 60 to 70% into large cap to give a steady return. To participate in the market, you get a 20% to mid cap, and obviously you've seen small cap are quite volatile. So 10% is giving a decent exposure. So that way it is a true index which is covering all the three categories, large, mid, and small.
Sir, then the next question comes is the reconstitution process. I found it very interesting, the word reconstitution process. So can you elaborate on the semi-annual reconstitution of the Nifty 500 index? How do changes in the market conditions influence the stock inclusion or exclusion?
So when we talk about passive funds, so it's not actively managed by the fund manager. So how you realign the portfolio to keep it in line with what's happening in the market. So for that, we follow rebalancing. So the index is created with the top 500 companies in terms of liquidity, in terms of free float market cap. So every 6 months, the stock, which is doing pretty fine, which is good market float, will come into 500. There are some stocks which are not doing well, will move out from 500. So whenever this movement is happened, the fund has to replicate the same index. So that's why it's called rebalancing. Every 6 months, those stocks which has become doing very well enter into it. Those are not doing great, moving out. So that's why when this rebalancing happens, we replicate the same into our portfolio. So although it is a passive, but within passive, rebalancing keep this fund active. Because the companies are doing well and continuously coming into it, those are not doing well, going out. So that's the reason this rebalancing help to keep this portfolio active.
Okay. So then what about the tracking error? I mean, what steps are being taken to minimize the tracking error for the fund compared to the Nifty 500 index?
Great. So before we talk about more on Nifty 500 tracking error, why we take tracking error as a consideration was passive is a fund in which every fund who is replicating an index is similar. So how you differentiate is one is the expense ratio and second is a tracking error. Because as well as a tracking error means you are exactly mimic the index. What we in-house do, majority of movement in tracking error you see on the rebalancing days. So on the rebalancing days, stocks are moving out and some stocks are moving in. So that day we make sure that we are able to time it across the day, a spread, so that the impact should be minimized. Second is whenever the funds are coming in our portfolio, we make sure that we're able to buy at the same time so that it will able to mimic the index as closely as possible. That's why you see maximum tracking error across our products are on the very low side. It's in second decimals.
So now the next, I think this is one of my favorite questions when I was actually working on this, discussion, is that the economic growth exposure. India shining, India growth story, massive, massive outlook for, we being, trying to be the 5 trillion, 7 trillion, 10 trillion economy and all these things. Now, given India's predicted economic growth story, how does this fund position itself to maximize benefits from this trend?
Great. So when you talk about India growth story can only be possible if it reach out to the last leg. So sticking to the majority metro cities or the top large companies, we can't expect that India story to grow. So as we all feel that India story is growing, it's clearly visible, which helps in better earnings, which helps in more expansion of the businesses, more diversification of the sectors. So this particular fund have more than 50 sectors, which means it is truly representing the entire India input. So when we see the trajectories moving up on the economic side, we see all sectors will participate. So if you want to win within one pocket, within one fund, if you want to participate all the sectors, this fund gives you that visibility. This funds give you that possibility to participate in the entire Indian growth story.
Okay. Very interesting, sir. So then, actually, now my next actually on that 50 sectors is that, the fund offers exposure to over 50 industries. Now, there are two prongs to this question. One is that, do you think this is over diversification because we have such thing as over diversification? I think that's one aspect of it. And after that, answering the next question is that which sectors, according to you or according to the AMC, are expected to drive performance in the coming years and why?
So I'll divide it into two portions. First is which all sectors which we feel are driving the Indian economy or we feel are growing. And second is this over diversification will impact the returns? So we'll bifurcate it. We'll start with the first. So considering in India, we have seen what happened in last 10 years with the UPI movement, financial inclusion. This digital financial inclusion helped financial services to reach out to the last line. The banks, the account opening with the digital era of the way mutual fund have reached out. So this expansion has given financial sector a great edge. This tech helped financial to reach out to the last leg. So that's one sector which we feel is going to be a growth story of Indian economy. IT and tech is what we are driving for the last 30 years. India is the main driver not for the country but for the globe. So that sector we still feel will be the major part of Indian engine. We have seen a lot of infrastructure and manufacturing happening in India last 10 years, seeing the kind of roads that's developing in India, the Make in India story we have seen is helping us in increasing the manufacturing in India. So this, again, a sector which we feel is going to be a major contributor in the growth story of India. Fourth is, we are talking about rural economy now. We are talking about the tier 4, 5 cities. So consumer good is again a sector in now in the entire country is developing. The consumer goods will definitely going to benefit from this story. So these are some of the key sectors which we think will be part of the major growth story of the Indian economy. Now, when you talk about over diversification, the beauty about this index is it's a free float market cap. So the large cap have a heavy weightage. So our particular sector is doing well, the weightage is automatically get increased. Now, good part is, let's suppose there are more than 25 sectors which are not part of Nifty 50, Nifty 100, Nifty 200. So you're missing out those sectors. If that particular sector does well, that will start growing in this index. and you get to chance to participate in that as a sector. Currently, it is a small piece. So your portfolio has a small piece into it. But if it start growing, you will participate into it. So that's the beauty about this index. It's a free float market cap. It's not a bias from the fund manager side or active side that we're taking a call on a particular sector and increasing that exposure. The sector which does well will automatically get more weightage into it. So that's the beauty about this product.
That's quite interesting. I mean, when I was actually studying for this discussion, I was under impression that how will this story will play out, and I think thank you for explaining it so well. It gives me a nice indication that how this generally fund management works. So the next question is about the risk. Obviously, when it comes to any equity products, equity related products, we have the risk factor for us. So this is as the brochure says, a high risk fund. So, what specific measures are implemented to mitigate the potential downside risks?
So okay, so again, when we talk about this as an index, I use a same word which I'm using from last 10 minutes. It's a free float market cap.
Correct.
So it says the bigger the stock, free float, will have a more weightage. So we have seen wherever there's a higher free float and high free float market cap, you find more liquidity.
Okay.
So with the more liquidity, it is easy to enter and exit the stock.
Okay.
Top 500, although company are 500, you still see 70% is a large cap. So a large cap is Nifty 100. So 100 companies still constitute 70% weightage of the portfolio, which helps you to mitigate the risk also. 20 and 10 are giving you a participation in the growth story. 70 is giving you protection in terms of liquidity. So that's because being a passive fund, it is not taking any active call to increase more mid cap or small cap. It is automatically, if you talk about 5 years back, it was 81% large cap. Now it is 70% large cap. So automatically mid and small cap will do well, will get more participation. And when they grow, the liquidity improves. So that's the beauty about the passive. If the stocks start doing well, with the more market cap, free float market cap, it will start getting more liquidity. If large cap start doing well, we see reverse cycle, then it's automatically protecting the liquidity side. So that's why this product is very well diversified in terms of liquidity.
Okay. So then the next question is about the cost efficiency. It is a very standard question: active management versus passive management. Active fund versus passive fund. Active funds are a little expensive. Passive funds are not expensive. So and because obviously there is no active management as such. So how does the cost structure of this index fund compare to the actively managed funds in the same category? And what is its expected impact on the long-term return?
Sure. So if you talk about, as per the guidelines, passive index, the capping is 1% at the highest expense you can charge in this particular product. And what we have seen, average active fund expenses are between 175 to 225 to 30. So it's a typical half of what you're getting in the active funds. So if you consider 1% over a period of 10 years, with the compounding, we can give a cap of at least 15 to 20% of the total return. Although 1% looks small in 1 year, if your journey goes into 10 years with the compounding, it can give a decent 15 to 20% impact in your portfolio.
Correct. Yes.
So that's clearly reflects a small thing compounding can impact into your portfolio. So that's a basic difference between the expense in active and managed. Although active definitely can generate alpha, fund manager takes a decent call and you understand the cycle and you participate in. But if you consider apple to apple only the expense ratio, the advantage is much better. You're getting a product at a half of the cost.
Sure. Correct. Yes. So then my last question is about the SIP and the systematic features. So could you share insights on how the systemic features like SIP or STP can benefit investors in this fund specifically?
So if you think about as an investor, you're buying a stock. For buying 500 is impossible to even the large of the family offices. So now the people, we believe that we want to participate in the Indian growth story. We want to participate all the sector. Whichever sector does when we grow, we want to participate. So this index of 500 stocks coming in with a single 10 rupee NAV. So you're getting a chance to getting the entire 500 with a single portfolio. SIP, how it helps? What we have seen over a period of last 30 years, we can never time the market. So it's better. We should be disciplined. Boring and discipline is the best solution to get return over a long period of time. So SIP is investing day in and day out. It is becoming your second income. When you reach to the retirement, this baby will give you what you need. So over 10 years, you're regularly investing at whatever the market level is without timing. We have seen the returns of SIPs much better than the returns on the lump sum side. Every month
Correct.
you're investing, where the market
Yep.
going up, where the
Sure.
market coming down. So that's about beauty about SIP.
Okay. Thank you so much, sir. I think that was pretty much about it. It was a very nice discussion. I had my doubts about index fund cleared a lot, and especially when it comes to the actively managed fund versus passively managed fund. And thank you so much for this discussion. Thank you so much for the time that you gave us. I hope that the fund does get good amount of subscription and opens to a huge response whenever it comes onto the market. And thank you once again for joining with us.
Thank you, Vinay, and thank you that you're looking to passive as a space and you're giving opportunity to your distributors and investors to know more about
Yes.
not but what's happening in passive. Thank you.
Yes. Thank you so much, sir.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.